The definition of fair value focus on assets and liabilities because they are a primary subject of accounting measurement. Remember this, primary subject of accounting measurement. This you remember. We have two things. We find out profit or loss and what is the financial position on at the measurement date, last of the accounting period. So we measure only assets and liabilities. In accounting, there are 5 things, as you know. First thing, something happened to the business, can be an event or a transaction. They are recognized either as asset, liability, income, expense or equity. Equity is the difference between assets and liabilities. Then they are measured, putting value to that. Accounting is a measurement process. Without putting value, doesn't make any sense. Everything has to be translated into monetary terms. What is the value of the plant? What is the value of the machinery? Fourth is our disclosure. So here, what they say? Definition of focuses on assets and liabilities. They never focus on income and expenses. Why? Because they are the basic measure of assets and liabilities. REAL, real. What is R? Revenue. What is E? Expenses. What is A? Assets. What is L? Liability. Real. Can there be any revenue without incurring any expenses? The answer is yes and no. The answer is yes and no. If you have some revenue without any expense, is what? That is a government grant. So what we are taught, debit the receiver, credit the giver, wrong thing. We receive something from government, but we don't pay anything. So we are the receiver, no giver. On the contrary, I pay some penalty, outflow of money from the business. Government has imposed some penalty on us. We pay money, what do you get back in exchange? Nothing. So there cannot be anything without incurring expenses, revenue cannot be earned. Okay? For meeting expenses, you need to have what? Assets. Yes or no? And to have assets, you need to have liabilities. In the balance sheet, when we prepare balance sheet, we show assets is equal to liabilities. Why? If I have some asset, I need to have some liability. Why they are equal? Because accounting is done from an artificial person. An artificial person has no capacity to own any asset, nor it has the capacity to pay off any liability. So if he gets some asset, it has to incur some liability. So their focus is only on assets and liabilities. What is an asset? What is a liability? What is revenue? What is expense? Revenue is what? Income from ordinary activities. From my central operation and ongoing process. From ongoing central operations. That's my revenue. what I deal in, what I buy and sell. Second thing is expenses. What are the amount incurred or due to earn those revenue. Without that, revenue cannot be earned. Now, to meet expenses, I have assets. What is an asset? Asset is what? Asset provides me future economic benefits. If I buy one asset, I expect the asset will be used for 10 years. That means what? For coming 10 years, the asset will provide me expected future economic benefits. Okay? And what is liability? My future obligations. So remember, profit and loss is the item for PL, asset liability is the item for balance sheet. Most important thing is what? An asset is not an asset on the balance sheet date. It will provide me expected, I emphasize, expected future economic benefits. Why do I say expected? Because there are risk and returns. What are the returns? Return is from profitable operations. I expect to get profitable operation. I'll be converting raw material into finished good by using that asset. Okay? At the same time, one more profit that I will be able to get some money when I discard the asset at the end of its economic life. Likewise, the liability is also not a liability on the balance sheet date. It is my future obligation. A liability is not payable on the balance sheet date. It is future obligation. How do I pay this? Say my lease liability 20 lakh rupees. How do I pay in next 5 years? It will go on increasing, interest charge, it will be reduced when payment is made. Okay? Here the emphasis is on assets and liabilities, not on expense or revenue. Because first thing remember, we actually prepare balance sheet first. But our common sense view is that we pay profit. No. First we decide, say for example, what will be the value of the closing stock. We make a physical valuation. That is written in balance sheet first. Thereafter, it will find a place in the profit and loss to find out what is the cost of sales. My account receivable, 10,000 rupees. I anticipate, I have apprehension, 10% might go bad. So value is not 10,000, value is say 9,500. Suppose 500 is my provision. That provision find a place in the PL later on. First my balance sheet this. So increase of an asset without a corresponding increase in liability is my gain. Decrease in asset without corresponding is my loss. So our emphasis is only on assets and liabilities. So find out profit and loss. So here also they put emphasis on assets and liabilities. Second one, fair value is a market-based measurement, not entity-specific measurement. I need to see what market participants use those assumptions. What is entity specific? How much depreciation I will provide? Entity specific. This has nothing to do with the outside world. But what value somebody is offering when I want to sell an address, that is market specific. What I expect is entity specific. So here everything I need to see that what is the position in the market for that asset, what price I can expect for the market. It is market-based measurement, not entity-specific measurement. Third thing is what? A fair value measurement for a particular asset or liability or a group of assets and liabilities. It can be for a standalone asset. It can be one cash generating unit, a group of assets and liabilities, or when there is one business combination, my company is being taken over by something, what is the fair value of the total group, that is identifiable assets and liabilities taken over by the parent. So three things we need to remember. First, I tell you, I repeat, focus is only on assets and liabilities. not on expense or income. What is the fair value of an asset? Fair value of an asset. Suppose fair value of an asset is carrying amount or asset is 100 rupees, and if fair value is 120, thereafter the entire thing will be adjusted in balance sheet only. Likewise, on liability, what is the fair value? Adjustment only in balance sheets. Second thing is what? It is market-based measurements. We take into consideration what is happening in the market, what market participants. I'll tell you who are market participants. In the market, what is happening, not what is on entity specific. And number 3 is, it can be for one standalone asset, a group of assets, just like cash generating unit, assets, liabilities taken together. They independently have the capacity to generate profit. And third, for a business combination, it is identifiable assets and liabilities.